All right, if you're in the world of institutional investing, you know we're always scanning the horizon for the next big thing or the next big threat. Well, today we're diving into one that is literally ticking like a time bomb, the crisis in the Strait of Hormuz. And we're going to break down exactly how it could blow up your portfolio.
Now, that's not just some clickbait headline, it's a really stark warning. What we're looking at here is a potential stagflationary shock in the making. And for anyone managing a portfolio, this is, well, it's the ultimate stress test. We're talking about a scenario that could completely paralyze central banks and just shatter all those traditional asset allocation models we rely on.
Okay, so let's get into it. Section 1, the stagflation shock. Think of this as a 1970s-style crisis, but with a modern and frankly much more amplified twist. At its core, stagflation is this toxic mix of soaring inflation and plummeting economic growth, all kicked off by a massive energy supply shock. It's a throwback for sure, but this time it's armed with a whole new set of dangers. So that leads us to our next section, quantifying the crisis. We're going to analyze the economic damage specifically for portfolio managers. Because, let's be real, hypotheticals just don't cut it, right? We need to quantify the risk. And let me tell you, the data from some of the leading institutions, it paints a really sobering picture of the potential damage. Okay, take a look at this breakdown from the IMF. It's pretty revealing. I mean, even their optimistic case, with inflation at 4.4%, is a huge departure from the kind of disinflation we were all hoping for. But here's the real kicker. The IMF's chief economist is on the record saying that the adverse scenario, the one that pushes Europe and Japan right to the brink of recession, well, that's looking more and more likely. And the severe scenario? That's not just bad, that's a full-blown global recession.
And here's where it gets really stark. The Dallas Fed ran the numbers. They estimate that a closure of the Strait of Hormuz would slash global GDP by 2.9 percentage points per quarter. That translates to this number you see here, a staggering $750 billion in lost output every 3 months. Just think about that. If this goes on for a year, we're talking about a $3 trillion hole in the global economy. That is massive.
Okay, so all of this economic damage, it leads us directly to the next phase of this crisis, what's being called the central bank trap. We're going to talk about why monetary policy is essentially paralyzed, and this is a situation that just completely upends the standard playbook central banks use to manage the economy.
So, the critical issue here, and this is really the key, is that stagflation is a central banker's absolute worst nightmare. Why? Because their main tool, interest rates, basically becomes a double-edged sword. It's exactly like trying to slam on the brakes and hit the gas pedal at the exact same time. You just can't win.
And hey, don't just take my word for it. The Deputy Governor of the Reserve Bank of Australia, Andrew Hauser, he summed it up perfectly. He called it a central banker's nightmare. And he's right. This isn't just some difficult decision, it's a true nightmare scenario where every single move you make just makes something else worse. You're forced to choose between two terrible outcomes.
And this is it right here. This is the impossible choice. So imagine you're the central banker. Do you raise rates to fight inflation, knowing full well you're going to crush the economy and trigger a severe recession? Or do you cut rates to protect growth, but risk letting inflation just run wild, maybe for years, just like what happened in the 70s? There is literally no easy way out of this.
So, faced with that impossible choice, what did the world's major central banks actually do? Well, they did nothing. They froze. On March 18th, you can see it here, the Fed, the ECB, the Bank of England, they all just held. And analysts are now calling this a global hawkish hold. It's basically a state of total paralysis. They're too scared to raise rates because it'll cause a recession, but they're also too scared to cut them because that'll just fuel inflation. They're stuck.
All right, let's bring this all home. Section 4, sector and portfolio risks. Because the big question is, what does all this macro paralysis actually mean for your asset allocation? Let's translate these huge systemic threats into specific, tangible risks that you, as a portfolio manager, need to be evaluating, like right now.
So a big question you might have is this really going to be worse than the 1970s? I mean, it's true. Our economies are less reliant on oil today. But here's the thing. The impact of a shock is now massively amplified. An oil crisis today isn't just about what you pay at the pump. No, it ripples through everything. Fertilizers, petrochemicals, global shipping. It's a cascade effect that disrupts every single supply chain on the planet.
And here's the bottom line for your portfolio. Let's just run through these key exposures. First, sovereign debt. You have to be watching for a potential wave of defaults in emerging markets. For equities, you're looking at a severe contraction risk for industrials, particularly in Europe. Energy stocks? They're going to be on a wild ride, super volatile, with unpredictable government policies popping up. And then you've got shipping, logistics, and agriculture. All of them are going to face sustained, painful pressure on their margins. So this leaves us with the critical question, not just for the policymakers, but really for every single investor out there. With the very real risk of a severe global recession on the table, should central banks just go all in and fight inflation at all costs? Which poison do you pick? A deep recession to tame prices, or runaway inflation to try and save growth? There is no easy answer here. And as we've seen, this inflation time bomb is already ticking. So the real question is your portfolio prepared for the fallout?